one of the questions we recently received from a listener was if it's better to use a high yield savings account or to invest. And that is what we will be discussing today. You're listening to Investing Mastermind Podcast. My name is Signe Lundhold.
And I'm Michelle Markey.
So a question we recently received was, now where the interest rates are high, is it better to actually just put your money into a high yield savings account, or should you be investing your money right now? And that is a very good question. What are you going to do? And Michelle, I'll throw the ball to you immediately. What would you do? Would you put your money into investments, or would you put your money into a high yield savings account these days?
Yeah, I mean it's definitely a challenging situation because the market has still been pretty much at all-time highs for a while, like many years since 2020, and it's been somewhat difficult to try to decide, would I rather be fully invested or partially invested or have a lot of that money in a high yield interest savings or bank account. And I've done a little bit of both. I've been forcing myself to invest more, even though it doesn't feel like I should, because I see other investors like Warren Buffett and Berkshire Hathaway. They're sitting on a huge cash pile. And even though what Warren Buffett is doing compared to what I'm doing is definitely on a much different scale, but it makes me wonder, if the best investor is not investing very aggressively, why should I? So I've heard other investors tell me that I shouldn't be afraid and I should be fully invested because this could be the start of a bull market. And I try to listen to a little bit of that. So, in spite of some of my misgivings, I've been forcing myself recently to just buy stocks, even if it's not the most on sale, but I'm just buying incrementally a little bit. And I still have a pretty large cash cushion in case maybe it's wrong, or maybe the stocks will go even more on sale if we do end up having a stock market crash someday. So I'm sort of doing a little bit of both.
All right. Well, it's super difficult, right? Because on the one hand, today you can actually get a okay yield on your savings account. Like here in Denmark, where I am, it's like 3-4% these days, which is more than it's been in years. And on the other hand, like you say, Michelle, the stock market is to a large extent overpriced. There could be stocks, individual stocks that are trading at what Warren Buffett would call a discount, but in general, stocks are expensive right now. So here, what I have done is I have a lot of cash. They are in my brokerage account because my brokerage account will give me, or my broker will give me 3.14% to just have money in the broker's account. So I'm still getting some interest out of having my money sit in that account. And then I'm waiting because I must admit that in 2019, I also got, I was like, okay, I want to do something with the money. I really want to start investing, and the market, it seems like it's never going to go down. So I did buy some stocks at the time, even though the stock price were higher than what Warren Buffett would usually recommend that I would buy the stock at. But I was just being really impatient and wanted to get into the market. And what I learned was that it wasn't a good idea. It took a long time for that stock to regain momentum after COVID. And it's, I've been able to still earn some money from that stock, but still it was kind of not very fun to do that. So now I'm just trying to stay patient and actually not doing a whole lot of the activities that I would usually do, even in a bull market where I would usually do other things while I waited. I'm kind of waiting it out right now because I'm concerned about the market right now. I think it's odd how the stock prices are continuing to increase, but we see that spending stalls. So people are not buying things these days, and companies are telling how they're not growing. And I just think there's like something that's kind of disconnected. If the companies behind the stocks aren't growing, then how come the stock price is growing? That's what I think. So that's my first thought on that. But if there was an individual company that I had actually been looking deeply into and actually knew something about that was trading at a discount right now, yes, of course I would be buying it, but I do have a lot of cash and waiting and being incredibly patient. I'm so proud of myself.
That's
I'm,
great.
yeah.
I mean, we should strive for that as well, like having the patience to wait there in cash, because that's one of the differences we'll see whenever there's opportunity. The people who are ready to pounce, like you are, ready to pounce with your cash, compared to someone who is just investing at the top of the market right now. And when the stock market does crash, they'll feel like they have nothing to invest with anymore. And now they're just in the red. So, if you don't wanna be completely in the red potentially and have bought at all-time highs, it would help to have somewhat of a cushion. So, yeah, that's why I'm also kind of hedging somewhat by having a lot of my cash in a 5% high yield, either savings account, or also in my brokerage account, there are some money market funds that are basically US Treasury bond based. And I've just kind of settled on those for now because it's very liquid. I can easily get my money out of my either high yield bank account or also the brokerage account where I have money market funds, and it's just straightforward to me, as opposed to I could buy US Treasury bonds like in the brokerage account. Like some of my friends have asked me, what would I do in terms of buying bonds? And you could do that. There's nothing wrong with it. And some people say, like, if you want to lock in some of your 5% bonds, you could do that now, but I'm just not as accustomed to it. So I haven't really tried very hard to look into bonds so much, but it's not like there's anything wrong with it, but you just should be aware of what you're signing up for if you were to invest in bonds, because they often say that as yields go up, the price goes down, or the opposite. As prices go up, the yields go down. So people just have to be aware of what that means in a bond. And if me just saying that to you, if you don't immediately know what that means, you might not know enough about what bonds are about. So I would encourage people to look into that more, even if it seems attractive right now to lock in that 5% bond yield.
Yeah, yeah, exactly. And it's very important information because US Treasury bonds that you're talking about are usually considered a safe investment. And that's why also Michelle is talking about that, she put her money, some money into something like that. And there are many opportunities to buy that, even though you're not in the US. Some brokers, even abroad, you have the opportunity to actually buy US Treasury bonds, or there are certain ETFs. But as Michelle said, with everything that you're doing, you need to understand what you're doing. And I think for me, what I heard was that even, when bond rates were super low, there would still be people buying bonds, which was kind of not at a great time to buy bonds because they really didn't have any yield. So please do look into what you're investing in before you're doing it. So Michelle, for somebody who is a beginner, what would you actually recommend them to do? Would you say, okay, put your money into a savings account, or do invest in a few stocks if they want to do it? Like, what would you say to a beginner?
Well, I mean, I think it depends on your comfort level and how patient you're willing to be. There's some people who want to get started right away, and even if they might risk losing their money, they might want to get their feet wet and just experience it for themselves. So it really depends on one's temperament. But what I would maybe do if I'm a beginner and I don't know anything, I would maybe consider having half of my money in cash in a high yield savings account, and maybe half of your money you could experiment with investing. And I'm thinking it's somewhat low stakes, because let's say you're a beginner and you don't have a lot of money you're working with. I see that as a little bit low stakes. You could see it as a big deal, because let's say you only have $1,000 and you put $500 in a high yield savings account and you risk the other $500 in stocks. And it might seem like a lot of money to you at first, like, oh no, what if I lose this $500? But in the grand scheme of things, the more you build your wealth as you grow and get more money in your life, the $500 will not seem as big of a deal. But if it helps you to experience what it would be like and go through the emotions of, oh, I put all this $500 in Tesla and then it went down. And if you experience that pain and you don't want to feel that pain again, then you will make a different decision. Like, that happened to me when I was younger, and I put like $500 in some like not so good stock that I knew nothing about, and it went down, and I was like, why am I in this? So if it helps to know what it's like, I would encourage that. And I wouldn't worry so much about if you lose the money because you can always earn it back. Like you can work more hours or do a side hustle or just save enough, like maybe not splurge and eat out as much and save up that money to make up for your loss. And something to keep in mind is you don't have to get the money back the way you lost it. So just remember that. You might be like, oh, I really need to get my $500 back in the stock market, but just allow yourself to make some mistakes and you can get it back someday. So that's what I would encourage people to maybe consider.
I think that's kind of fun that you mentioned that, or it's like that's exactly what I did. So, felt the pain, and now I'm like, nope, I do not need that pain. So, yeah, it's actually kind of fun way, different way of saying it because most people would probably say, oh, just be careful, you shouldn't make any mistakes, but it's actually by making mistakes that you learn a whole lot. And if you do it with a limited amount of money, you're good. If you do it with a lot of money, yeah, then it's going to be extremely painful. But it's finding that balance of how much should I actually lose in order for it to be painful enough for me to learn from it. So I think, yeah, that's very good because I'm definitely, I've been burned. I don't want to be burned again, which gives me immense patience. And I'm not known to be necessarily the patient type. Like I said, I'm very proud of myself for being able to sit on my hands and just learn a whole lot these days. It's actually an amazing learning opportunity right now. You can spend time looking into great companies. We've already been through some of the parameters in earlier shows about what is it that you should be looking into before you buy a stock. And you could be doing that homework right now. Instead of buying stocks, you could be learning. At least that's my opinion.
Yeah, absolutely. And I've been doing a lot of the same over the last few years with not many stock market buying opportunities that I feel comfortable about. And I still make mistakes now. So even with having invested in some like good quality companies that were tumbling in 2022, and I sat on my hands then because they didn't seem on sale enough. So my area that I'm getting stuck on is I fall into the trap of thinking that some stocks are not on sale enough and I need to get over that. So that's why I force myself to say buy some Apple that even though it may or may not be fully on sale, it's okay. Even though it may only be, let's say, 10% on sale. We don't know. I'm not saying I know exactly what the valuation of Apple entirely is, but I'm kind of thinking maybe I'll buy a little bit. I will gradually add it as it's going down. And if it goes down a lot, then I would buy even more just because I believe in this company and I use their products and I think they'll be bigger and better in the future. So, in that sense, it's like as I'm doing a little bit of homework, I'm also starting to force myself to invest, even though I feel like I shouldn't. And maybe that's part of what we'll see in the market is the last people to hold out in cash, like the two of us and Warren Buffett. We are some of the maybe people holding out with cash. And the moment we start to buy a little bit into the market, maybe that's when we might see a stock market crash where everything will go on sale because it just feels like kind of crazy how the market has been going up in spite of the federal funds rate remaining pretty high, which dictates the interest rates of a lot of other things like mortgage rates and loans that you might get for a car, that these rates are pretty high up. So at some point that's going to slow down the economy enough. So it's kind of opposite that we're seeing the market go up. Normally, as interest rates go up, the stock market should be going down, but it hadn't been doing that. So at some point, as Sina said, it's a little incredible how companies are still being traded at high rates, but they're not necessarily growing or making that much money. And what I suspect is that maybe some companies are kind of using their cash in maybe not the wisest of ways. Like they might be buying back their stock at high valuations. So, in effect, they're burning their cash at an inopportune time. So, instead of growing the company, instead of investing in the people and the products and services they offer, if they're buying back shares now, they could be doing it at a detriment, like just so they make it seem like the company's doing well. And people often mistake that the stock price going up equates to the company doing well. That may not be always true, like you would think it should be, but some people can game the stock because a CEO is motivated to get their compensation packages by trying to pump up the stock. And what's an easy way of doing that is buying back the shares. So that's something that we could be seeing playing out right now, or a company could be borrowing money to be able to pay the dividend. So people who are hooked on dividends, the company could be going into debt just to pay you a dividend, which is totally a bad capital allocation strategy. So you have to wonder, why are some of the dividend yields high if that's what you're chasing by being invested right now? It may or may not be for the better interest of the company to keep doing that. So just some potential things to consider of be careful what you're invested in is basically my moral of the story.
Yeah, I 100% agree. And I do see that too. Exactly the scenarios that you're mentioning right now. Also, especially, with the dividend companies that has been paying a dividend for many, many years, the revenue, the sales stalled. Now they still kind of need to show the shareholders that they can pay a dividend, because if they do not pay that dividend, then shareholders will leave. And we see that over and over again. Then when companies stop paying the dividends, then people are like, oh, nope, then I'm in this stock to get my quarterly dividend. So they sell the stock, move to something that'll pay that dividend yield. So some companies are so afraid that shareholders will leave that they, like you say, they just take on long-term debt. And that's how they're able to actually pay their shareholders the dividend. But with the current interest rate, they also have to actually pay back that debt at a very, very high interest rate. And at some point, that's going to spiral out of control. And that's why we always look at the debt in a business to make sure that that's low. And what I can see is, for a long time, everything was the companies could see growth in revenue. Everywhere there was growth, people bought things. But now people aren't buying things anymore. And that means that companies that does have long-term debt and did not pay that debt off while the interest rate was low and while revenue was going up, they could potentially be facing some headwinds right now. And I know it's getting very detailed, but it's just some of those things where we can see, okay, so one company starts failing on their debt and then it can snowball into a crisis. Well, we can't foresee what's going to happen. It could be a lot of things that are impacted.
But
What is odd is that stock prices are going up and interest rates are going up. That's kind of like strange.
also, to add to your point, what we can see a little bit, as has been reported in some media outlets, is that corporate debt is on the rise, and a lot of that could be coming due in 2025. So it could be a perfect storm of a lot of companies were binging on cheap debt, and a lot of debt is coming due in 2025. And if they need more debt, they can't get more debt because the rates are too high and they're not earning enough to afford the debt that they already have. So it could be a perfect storm sooner than later. The more that these companies might default to some extent on their corporate debt, I think that potentially is an area that not enough people are talking about and could be contributing factor potentially to a systemic financial situation. I don't know exactly what that will be. Who knows what kind of risks are out there, but there definitely are some. And it's just a matter of, are we in tune enough with some of the signals? Like, some people are motivated to kind of sweep it under the rug because a lot of people will pull out their money out of financial institutions if they start realizing they're actually in trouble. And so a lot of people don't want to tell you the bad news because then they will lose you as a client and you won't just go along with the program and just blindly put your faith in financial institutions. You might be like, hold on, maybe I shouldn't just be, letting my money be invested by some guy in some investment or stock that I don't really know that much about. And that could be something we might want to look into if we're not sure what we're invested in. So things like that too is maybe something that people want to take a more careful look while everything is still calm.
Yeah, so right now it could be a good time to actually be in a high yield savings account, especially if you can pull your money out of that account immediately and invest those money once the market starts going down. So maybe you should do that right now, or there could be opportunities with stocks that are trading at a great price right now. Or you could do, as we also talked about, get some learning in and actually use it as an opportunity to buy something and then learn how everything went. And if you want to start learning, I definitely recommend keeping like a diary or a log over what actually happened, what was your feelings, what did you learn, because then once you write it down, you'll be able to remember it better. So we're coming to an end of today, and we'll be back on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.